Last trading day of the month, as we said, S&P's on pace for its first negative month in 5, but riding this 4-day win streak as we get into September. How should investors be preparing for the new month ahead? Wolfe Research Chief Investment Strategist Chris Senyek is with us here at Post 9 to celebrate the end of this month, although we might trim our losses for the month to 1% or so, right?
Yeah, I mean, we came into the week, oversold, and we had some better economic data in terms of the lower, jobs openings, and I think that was enough fuel to put the market higher here. September, we all know, is a very challenging month. October is, for that matter, as well. And it's conference season, and there's going to be a lot of corporate managements that are out there talking starting next week, and we'll hear what they have to say, because I think the economy, we all know and we all agree, the economy has slowed over the last month or so.
So you're nervous about the commentary. We were just talking about sort of the analysis of call transcripts for Q2, where sentiment had gotten a little bit better, at least by one estimate.
I think it's a bifurcated economy. I think on the one hand, the consumer's slowing, and that's what we think the biggest theme from now to the year end is going to be, is will the consumer slow enough that the market shifts from soft landing narrative to recession worry narrative? And then I think in tech, with these more stable business models, whether it's a Salesforce, a Microsoft, or others are seeing the secular trend from AI, I think they're benefiting, and they're almost a little bit becoming sort of acyclical at the moment, at least.
It's interesting. We had the Visa payment volume for the most recent month up 7, which was better than the prior month up 5. But then you have the savings rate back to 3.5, and you've got Challenger layoffs tripling month to month. Which is heavier? The constructive stuff or the harmful stuff?
We're worried about the consumer as we get into the fall here. You've got the student loan repayments restarting in October. You've got companies looking at year-end to make their numbers and cut costs. And you have the excess savings, by all accounts, no matter how you measure it, finally dwindling down. It's shocking what happened to these sentiment surveys, both institutional investors and individual investors, after a drawdown in the NASDAQ of 8%, right? They really fell. And that shows you, to me, how sensitive spending is to not only the stock market, but gas and food prices.
But Chris, and I read your notes because they're very good, you've been cautious on the consumer from the beginning of the year and cautious on the stock market as well. August was a down month, but we're still looking at gains of more than 17% year to date. So the economy didn't surprise you in terms of the resilience and change your forecast?
The economy is surprised to the upside, right? At the end of last year, it looked like we're going to go into recession, and then the consumer came out and spent. And the trends that were in place in the first half of the year, which I think are really two, is the excess savings drawdown, which we underestimated the extent to which consumers would do that and tap home equity loans and tap credit cards. And then secondly, when the Fed came in and rescued the banks in March, that added fuel to the fire. And then you throw NVIDIA's upside guidance in early May, and that was the ingredients for a very strong market. We just don't see those trends in the back half of the year. You have liquidity going out, right, as the Fed draws down the balance sheet. You have the consumer slowing for the aforementioned reasons before. And I don't know what the impetus is going to get the economy to reaccelerate.
But even if we see weakness, as you're describing, into the fall, do you think we can get away with the soft landing, non-recession, with the Federal Reserve stopping to raise rates? Because that's the sort of Goldilocks scenario that the market has latched onto, which has helped stocks and bonds lately.
Yeah, so I think over the near term, the market's going to view this bad news as good news scenario. As we get into Q4, I think as people start to recalibrate the soft landing narrative to a recession being more imminent or possible.
So you don't buy it? You think it's recession?
I don't buy it at all. I think it's a false narrative, and I don't see it happening in the back.
So are there pockets within equities where you can sort of play out that thesis?
Yeah, I mean, we like energy. Energy is our favorite sector. Rig counts are down. It's been a strong group. The valuations are still cheap. We like the big 7 tech as a barbell hedge. Like, I think discretionary is a hornet's nest right now, right? Companies are missing here and there. So I think you have to kind of barbell it. Energy, tech, discretionary, energy tech, and then discretionary and industrials and some of the more defensive groups on the other side. Tech can work, I think, over the near term, as long as companies can make their numbers and beat them, right? I get worried as we get into the late in the year that tech companies start to give more cautious guidance. And I think when they give that more cautious guidance, the stocks are very much priced for perfection. So you have a market where the VIX is sitting around a 13 handle. The market's trading at 18 or 19 times forward earnings. Stocks are very much still priced for perfection into a seasonally weak period of time. Just not the time to really extend risk out here.
You are right about conference season next week. Communicopia and a bunch of others will be on watch for tape bombs. Chris, good to see you.
Thanks,
Have a good
Sam.
weekend.
Appreciate it. You too.